The markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. According to Soloway, Bitcoin may face a lot of uncertainties in the near term as a result of the ongoing global economic declines, and we can still possibly see the Bitcoin price drop to 12K even lower, before putting it at a bottom. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. All these things just go to the moon. But the problem is we're in a bear market. And in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in.
The stock market, bear market, you were calling for, I think, another 20% decline a month ago. We're almost there, Gareth, but people are calling for even more downside. What's changed? Anything changed in the narrative since last we spoke about a month ago?
Well, the narrative that has changed is the Fed has continued to be so hawkish. Much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end.
It's a pretty big jump, but only because there was a slight probability, I think an hour before 2 p.m. on Wednesday, there was an 18% chance of 100 basis points. That's what the Fed Watch tool was telling us. So it was more or less telegraphed. So yes, they are hawkish, but I'm wondering why the markets are still reacting as negatively even 2 days after the Fed meeting. Markets know this.
Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. The 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? Percentage wise, this is an enormous hike, way more than Volcker back then. and it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, oh, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a long-term bear market? And so there was just so much liquidity and money in the system that a ton of it wound up in the stock market, buying tech stocks, these tech stocks that had no earnings, that were trading at crazy multiples to revenue numbers. And now you're seeing this kind of suction. It's almost like a vacuum sucking the liquidity and the money out of the system through higher interest rates, through quantitative tightening, QT, and that's going to just bring down these asset prices. And we've seen, amazingly, like a stock like Roku down from $500 to like $60, incredible type drops in these assets, but it makes a lot of sense since the money is getting sucked out. There's not as much money to go around to so many stocks now. And that's the market that we've been in, where the Fed is like the parents always protecting the child. Well, guess what? The child is out of the house now. It can't be protected anymore.
It's scary how you and I are reading each other's minds. I was just thinking of that analogy. It's like we're a bunch of kids asking for our parents for more money. Daddy Powell, please give us more money. No, you guys have been bad. Inflation needs to come down more. But the Fed caused inflation. It's like say, Dad, you caused my problems, right?
Dude.
My grades are bad because you've been a bad parent.
Yeah, I agree. The market was just like a child learns from their parents. The market was doing what the parents were enabling it to do. The Fed is absolutely an enabler. And it's just unfortunate that all investors are going to have to pay the price.
Well, markets, like children, aren't happy when their parents cut them off. So I think that's we're going to see more of this tantrum. They called it the taper tantrum back in 2013. That's exactly what's going on right now. All right, so Bitcoin and Ethereum. So let's revisit your Ethereum call first.
First target is going to be back. So we are at a little bit of support per the chart. So you can see we bounced off these pivots right here. All right, and that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to 700, 600 area.
And that's going to coincide with the 3,700 S&P?
Yeah, so I think probably the 900 to 1,000 is the 3,700, and then the next leg lower in the S&P takes you down to that 600 to 700 level on Ethereum.
I see. And for Bitcoin, let's take a look at your Bitcoin technicals. You had called for 11,000, 12 to 13,000 for your base case low end.
Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin.
And you're buying with your hands and feet at $3,500, I assume.
Well, so to be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is, I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position.
Okay. I don't think I've asked you this yet, but if I have, let's revisit this question again. Did you buy with both hands and feet when it went to $20,000? You went on air a couple of times saying if it goes to $20,000 last year, you would buy with both hands and feet. Did you actually accumulate?
Yeah, I did buy back down there. Absolutely. Yep. Absolutely. So again, I don't know if it would be called with both hands and feet at that point, but I certainly did pick some up.
I guess the macro conditions turned even more bearish. So you updated your
yeah,
allocation.
And that's the thing. That's the thing that investors need to understand, is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more.
A friend of mine asked me in private conversation, and I'd like you to address my response and critique me if you think I'm wrong. But I love doing this with you, Gareth, because this is like a masterclass for me too. Now he asked me, should I buy Bitcoin? That was his question, not when, how much. Just should I buy Bitcoin? And I said to him, long term, I think maybe it has upside, but right now, wait until the Federal Reserve stops raising rates and then get in. Could you critique what I said?
No, I think that's right. I think you want to look for a Fed pivot. The Fed pivot will be positive in the near term for risk assets, including Bitcoin. And I think that's where you start to nibble. I'd strongly encourage your friend to kind of not go all in at that level, but instead just dip a toe in the water. If it drops a little bit more, do another toe, kind of do that. Because again, we just don't know, remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave.
All right, so last asset, gold. You did call for gold to be the best performing asset. The cleanest shirt in the dirty laundry basket is one might call it.
Yeah.
And it certainly has done that. I mean, not great performance, but not terrible either relative to everything else we talked about. What's next?
Yeah, so no doubt I've been disappointed in gold, even though it has been, I was correct that it is the best performing asset between the S&P and Bitcoin. But needless to say, I think it's down 6-7%, whatever it is for the year at this point. And I think overall we have to look at the strength in the dollar, right? So if someone told me the dollar was going to be up 17%, which I think is around what it is for this year, I would have said, okay, gold should be down 17%. Well, it's only down, let's say 7%. And because of that, I think that's showing relative strength. It doesn't make my portfolio happy to be involved in gold, but at least I guess I can look myself in the mirror and say, well, glad I wasn't all in Bitcoin with that money or in stocks. So I think overall, once you get a Fed pivot as well, once that dollar starts to come in, look for gold to really start to kick into gear. Also, if you happen to be trading gold in euros or yen, you're loving gold this year. It just happens to be because the dollar's strength that it's been underperforming.
Everything's down today, by the way. I mentioned, gold is down 1.4%. That's a huge move for gold. I mean, people look at a lot of people in the comments whenever I write these headlines, they're like, oh, well, gold only went down by 1.4%. Yeah, compared to Bitcoin, that's nothing, but take a look at what gold historically does on an intraday basis. That's huge. Is that because of dollar strength, or is that just because everything's selling off?
No, it's the same thing that happens in when COVID hit in March of 2020 and panicked everyone. You saw risk assets sell off, you saw gold sell off, you saw crypto sell off. And so there's a point where you start to get closer to a bounce in a stock in the markets, and this could be any market, where people are just throwing everything out the window. And I think that's what we're seeing today is you have interest rates that are just freaking people out. The dollar just keeps ripping up. That's freaking people out. And people are just saying, you know what? I'm exiting everything at this point, and I'll ask questions later. Now, we will probably see things like gold start to recuperate faster like we did during the COVID collapse, but that's what's happening right now. People are just panicked. This is the first day I'd say where I'm actually sensing that panic in investors, and that means we're getting closer to a technical bounce.